Welcome back. The other theme that we're focusing on are the tyre stocks, because we've seen diverse moves from some of these large players. MRF is under pressure, margin pressures kicking in for MRF. CEAT, on the other hand, appears to have bucked those inflationary concerns and reported a margin improvement. Sonia is here with a deep dive on the tyre story. Sonia.
Well, thanks a lot for that. So, just to start off, let me tell you that there's no problems with the top line. So the revenue growth for MRF has been pretty solid this time. It's an 18% growth year on year. CEAT too has done well, and that's because of the pickup that we've seen in the OEM space. However, the problem really for MRF is in the margins, and it's very peculiar. CEAT is up 5% while MRF is down about 5 to 6% because CEAT has reported an improvement in margins quarter on quarter while MRF has seen a fall. So if you look at it, CEAT's gross margins have improved quarter on quarter to 32.5% compared to 31.7% last quarter, while the EBITDA margins have improved quarter on quarter to 7% versus 6.1% last quarter. In fact, for CEAT, for the last preceding 2 quarters, it was languishing between 6 to 6.5%, and there has been an improvement to 7% this time around. But that's not the case for MRF. MRF's EBITDA margins are down 30 basis points quarter on quarter and 230 basis points year on year, coming in at a multi-quarter low of 8.2% versus 10.5%. Now, if you look at an average, right, MRF has been in this 10 to 11% range for a while, but this time around it has slipped. So what are the reasons? It's difficult to gauge because for MRF, the management really doesn't come out and tell us what the model mix is and why their margins are under pressure. But for CEAT, the gross margins have improved because of the price hikes that CEAT undertook in Q2. And the price hikes that CEAT took was then followed by competition. So the assumption is that CEAT went ahead and passed on all the price hikes to consumers, while other players like MRF couldn't do that to the best of the requirement, and hence this diversion in margin performance. Back to you.
Maybe in the coming quarters, they try and do that to offset the cost impact. Sonia, very interesting. Thank you very much for that. Completely opposite directions on both names. Before I go to Prakash and ask him about tire names, look at the market. It's basically, we've got a move, absolutely no doubt, the 230 move, but it's in the opposite direction as compared to what we've had in the last 2 sessions. We're down 76, 77 points, and almost all of it has come in post 230. So the tradition or the example continues, but today it's flipped. 18,126 is where we are at. And the bulk of the move, I mean, of course, a large move in the Nifty, but the